Hi, this is Melissa Kendall, and today I'm going to talk to you about measuring economic performance. So when you hear that the United States has the largest economy in the world, and that the GDP of the United States is estimated at $18.5 trillion, and the second largest economy in the world is China, which has just recently surpassed Japan, and China with $11 trillion and Japan with $4 trillion, what does that mean? And when you compare it to the smallest economy in the world, which is Tuvalu, which is an island between Hawaii and Australia, with a $32 million estimated 2016 GDP, again, what do those numbers mean? What does that number mean? How is GDP measured? What is it telling us? What is it not telling us? And how accurate is this measurement as a way of talking about an economy's performance, meaning is an economy doing well, is an economy doing poorly? So that's what we're going to talk about in this unit. And the first section of this is understanding how an economy works. So we're going to look at the circular flow model of an economy and the players in that, and then we'll talk about how do we measure an economy and using GDP and other forms of measuring economic performance. In order to understand how these measurements of an economy's performance work, the first thing we need to do is understand the basic flow of an economy. How do things work in a system? So we're going to look at the very simple model of every economy. Market economy is called a circular flow model of economics. So I'm going to describe it to you, I'll draw it for you, I'll explain it to you, and then we will add on to it. As we always do, we go from simple to complex in economics. So the first thing that I want to clarify, though, before I start writing, is that we're talking about a closed economy, meaning we're talking about an economy in this model that doesn't have trade with other countries. Later, we'll add on to that, and we'll show what free trade does to a circular flow model of an economy. So, we're talking about the circular flow. We're going to talk about who are the two players in the circular flow. These people, these decision makers in economies basically come down to two players in a closed economy. We have households, who are the consumers. So, I'm going to put that here, and I'm going to call it HH. Households, which are the consumers, and on the other side we have firms, which are the businesses, which are the producers of goods and services. Producers. Okay, so what happens in the circular flow model, we have the two players, we have consumers and we have producers. So what is going to happen is we're going to have a flow, we're going to have an exchange between both of these parties in multiple formats. So first of all, the thing that firms need is they need each other. Firms need households in order to get goods and services. So they are the factors of production. So factors of production, first let's draw this. This is such bad with this shadow, but I'm going to draw it anyway. So we have an exchange between households and firms. Households provide firms with the factors of production, meaning they give the firms what they need in order to produce goods and services that are available in the market. So those factors of production, we're going to call them FOPs, or land. Well, here's the big one: labor, capital, and entrepreneurship. Okay, so land is basically anything that has to do with the gifts of nature that are used in the production of goods and services. Labor obviously is the human labor that goes into creating good and service. Capital, we're talking about machinery and equipment in this situation. And entrepreneurship are those people that have the ideas and are willing to take a risk in order to create goods and services out of the other factors of production. So what happens is the households over here provide these factors of production, land, labor, capital, and entrepreneurship, to the firms. What do households, what is the motivation, what is the incentive for them to provide the land, labor, and capital to the firms? Yes, they want money. They want income. So the households provide the factors of production to the firms, and what the firms do, there's an even exchange back of income. So households get income from providing these factors of production to the businesses. Okay, now we're only halfway done with this closed economy model, this closed circular economy. What is the other piece of the puzzle? Okay, well, why do I do that? I'm a consumer, I'm a household, I've exchanged my labor to a firm, I've gotten an income. Well, what do I want with it? I want some goods and services. So the firms also provide, boom, goods and services. Goods and services to the households, the consumers. And I'm a consumer, I got those goods and services. What's the firm's motivation? What am I providing to the firms in exchange for those goods and services? Yes, you got it. I'm spending money. Expenditure. Expenditure is a word for spending money. So I am spending money and giving it to the firms. So you can see the circular flow of income. So firms are getting resources from the households. This top part of the model is called the resource market. Okay, households are getting income, they take that income and they spend it, expenditure, on goods and services that the firms produce. This is the product market. And in a circular flow model, the resource market is equal to the product market. So the amount of goods that firms produce and sell to households is equal to the amount of income that households get from providing resources, mostly labor, to the firms. Okay, so that's a closed economy. In the next section, we'll look at what happens when there is an addition of trade. Okay, so here we are with our final discussion on the circular flow of goods and services in a market economy. So in our previous discussion, we were looking at the two players, households who are consumers and firms who are the producers, and the good flow and exchange of goods and services and income between the two, which are equal. That was in a closed economy. Here we're going to talk about now adding the idea that there are some injections into the economy and some leakages out of the circular flow of income. So let's first look at the injections. So here we go. First type of injection that you're going to have into an economy could possibly be in the form of investment. When you have an injection, that means that you're getting money into the flow that is not just coming from the exchange of income and goods and services from the consumers and producers. So investment comes from firms. That means that firms are investing money, in capital goods for the production of goods and services. And those injections of investments are coming from leakages out of the circular flow in the form of savings. So when firms or consumers save money, they're putting it into a bank and they're not spending it, and those funds become available for firms to borrow to invest. And when they invest, it becomes an injection. Another leakage out of the circular flow would be in the form of taxes. So again, households and firms are not able to keep that money in the flow. It comes out of the flow and it goes to the government as a tax collection. However, on the other side, it can become an injection when the government spends. Government spending, well, they have to spend money, and the money that they spend are the taxes that they collect from consumers and producers. And then the other injections are in the form of exports. Exports are when firms sell goods to countries outside of the economy to another country. Then they receive money that is put into the flow. However, They also buy imports. When we buy imports, money is leaving the system. So if the injections are larger than the leakages, then the circular flow will grow. And if the leakages are larger than the injections, then the circular flow will shrink. And that is one way of talking about the size of an economy and whether an economy is growing or not. And we're going to talk about how those are actually measured in monetary values in the next segment.